The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. Central Texas Regional Mobility Authority is using Google AI to create smarter tolling systems and improve traffic flow for Texans. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
Hello, everyone. Welcome once again to the Talking Real Money show and podcast. I am Don McDonald with a mic level that's better now. That is Tom Cock. I have no idea how his is. Hopefully it's good.
I think it's very good. I feel great.
Fine to me.
You
feel good?
Studio. I do. Everything's hooked up. Things are working.
He's
I'm
at
good.
the house.
Yeah,
he's in the model military aircraft museum.
Part 2. Yeah.
Part 2, life is good. So we'd love to have you join us here on the program. And it's really easy. You just call in with your questions at 855-935-TALK, 855-935-8255. When we invest, we are in a very substantial way influenced by our personal memories. What do we recall about the stock market, and what we recall individually is going to affect the way we invest. And a great example of it is for us old people, and a lot of you in the audience are among our older age.
You're not supposed to call you old anymore. They keep telling me that.
You had parents who grew up toward the tail end, or were born toward the tail end of the Great Depression, or had parents who grew up in the Great Depression, great-grandparents, things like that. And they were very conservative in their approach. They really pinched pennies. Then you had folks who grew up during the 90s, in the big growth period before the 2000s and the fall there, and they were more comfortable taking risk. We are influenced by what we have experienced. It makes perfect sense.
It does, and I think recency bias plays into this as well. But what you're really talking about is the things that made an impression on us as we started investing. And as you said, my parents, of course, were survivors of the Great Depression. My father used to tell stories about friends who came over to their house to actually eat food because they didn't have any food. And they knew a lot of people who were out of work for an extended period of time. That is impactful on how you feel about money. And of course,
go over to Colonel Cox's house. He always has a meal.
Yeah, this was my grandfather's house. Who worked for the railroad. Yes, and he had fellow railroad employees who were out of work.
When you're working all the live long day,
you gotta
have more money.
You gotta have a plate of something. So a lot of this, and then this plays out in how you invest. And this is another reason, by the way, that I absolutely abhor the stock picking contest, because I think people do this as kids and they think that's how you invest. That is not how you invest, by the way. But so how about more recently, though? Because we've seen some things that have happened in the market that have established how people believe moving forward. And one of them, and we're taking this from a recent piece written by our friend Jason Zweig, is that growth stocks, think big, solid companies that have earnings, that kind of thing, they're doing well, perform better, make more money, if you will, than value stocks.
Okay, let's make it really clear. That's what many people believe.
Correct.
Because they have recently.
And nobody knows moving forward, of course, but if you look at the long haul, value companies have done better than growth companies. And there are people that are going to also tell you that value should do better in uncertain times. We could get into that argument, I think.
That was a Buffett argument. Yeah. I mean, that was Warren Buffett's argument all along, and it was an integral part of the research done by Eugene Fama and Ken French on parts of the market that have historically outperformed other parts. They found that value has done better. Now, there is a good reason for it, which we'll get to in a minute, but we are influenced by what has happened to us, and we have to control against that. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, Guessing leads to second guessing, and second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And once again, our telephone number is 855-935-TALK, 855-935-8255. Some of the other things that recently have probably led you to believe that there are some trends in the market that you should be a part of. You know, the trend is your friend. Well, the trend is your friend until it becomes your enemy.
Yeah, and another one is that the United States is the only place you need to invest in. You don't need to expose your money.
It's been the bestest.
Yeah, I mean, especially since 2012. I was reading some other research about this today about kind of the why of that. Is that because U.S. companies have been so much more productive? They've come up with great companies and other places have not? Not really. It turns out that a lot of it is due to the fact that the U.S. dollar has done much better than other currencies in that period of time. We still, by the way, just to go back to the growth versus value type of stocks, we're going to tell you to own both. We're also going to tell you to own the U.S. and international stocks. I know that's not a popular thing right now, although this year you've learned.
You know, the dollar is doing a little less
well. Yeah, it's having its struggles of late. So
I'm being nice.
Yeah, I mean, here's another one that he mentions: buy the dips and time will bail you out. This is so counterintuitive for most people, because right now most people are really got their finger on the button about whether or not they should sell something rather than buy it. And so investing is long-term. Investing is putting it there and leaving things alone.
It is longer term than most people think it is. You know, buying the dips can make sense, but the problem is it can't be a 5 or a 10-year time horizon. You could even, I mean, there's only been once in history where we had anything close to a mediocre 20-year period for equities, and that was really just the 30s.
But you still have this, isn't there that period of time like 1965 through 80 something?
70s to the 80s.
Didn't do very well.
But again, it wasn't 20 years. It wasn't 2 decades. So when we start getting longer term, then you start getting bailed out. But the one that really, and we're seeing this a lot right now, Tom. A lot of interest in gold.
Lots of money flying into it right now.
Gold has soared. You would think it at over $3,300 an ounce, that gold was at record highs, that gold had returned tons of money over the past, 45 years.
Something like since, let's see, 1980 maybe?
80? Yeah. So remember, gold first got really hot in the 80s, in the early in 79 and 80. It got really hot because of inflation, and gold's price rose, and people got very excited about it, and it got to about $834 for its high in 1980. That sounds like you made a lot of money, doesn't it?
834 to 3,300
to 3,300,
like 4 times or something. Sure.
Yeah, but after you adjust that for inflation, doesn't look nearly as good.
Yeah, and you didn't make nearly as much as you did even in Treasuries, even as much as not even close as what you made in a global portfolio of stocks, but you may feel
exactly
better.
And at the time, it felt like gold was the only place to be, because who wants to buy those scary stocks? And yet, hold on, I got to pull my number back up because I don't know what I did with it. I had it right here in front of me.
I have it because you sent it to me.
Because I sent it to you. Oh, good. Tom has the number.
10,000 in.
So this was at the peak of gold in 1980.
10,000 in gold. Went to about 20,000, adjusted for inflation. 10,000 in 10-year Treasuries grew from 10,000 to 160,000. That sounds pretty good too.
Adjusted for inflation.
But 10,000 in a global diversified portfolio, $362,000. So,
yes. Does gold sound like a good investment long term?
Stocks beat gold by 19 times in that period of time. 19 times. That should tell you everything you need to know. Everything.
Don't get caught up in recent memories or even distant memories, because when you look back over long enough periods of time, you find out that investing in business has been good business. 855-935 talk is our phone number. 855-935-8255, and I think that's Knoxville. I bet that's a typo. Hey, Steve in Knoxville, welcome to the show.
Yes, it is Knoxville. Yes,
lovely place. I love Knoxville.
Don
it's a beautiful
so
town.
highly of Tennessee and Knoxville. He loves that spot.
I do.
So.
I love that mountain area over there.
Oh yeah. We're kind of at the gateway to the Great Smokies.
I love it.
Wait, you can still smoke there? You can't smoke here anymore, so it's. I guess I wouldn't want to. I don't know.
Well, okay. It's the mountains. The mountains.
Ah,
are
the
mountains. To do that.
Okay, all right. Okay.
Yeah,
the mountain smoke.
Smoking mountains.
Yeah.
Okay.
Well, the kind of smoking mountains they have in Washington tend to be volcanoes, so we don't. They don't get that smoky mountain thing.
You don't want to get near
none
those.
of that here. None of that here. Yeah. No.
What's up, Steve?
I've been enjoying this Talking Real Laundry podcast.
Oh, God.
And
that came up. Yeah. Okay, I got to stop here. I'm meeting with clients yesterday. I've been clients for very supportive people. And thank you, the folks who were there yesterday. And the first thing his wife says is, "Did you ever get out of the laundry room?" I mean, come on, really?
It's my fault. Thanks for bringing it back up, Steve.
Well, no,
I appreciate it.
I've been listening about a year, and after hearing your ad on Clark Howard, so I've been enjoying it very much. This is a question. We've got a chunk of money that is set aside for construction of a house at one point, and it could be, a year, between maybe a year and 2 years away. So I'm wondering where's the best place to park that money for we don't know if it's going to be a year or 2 years, but I recently got something from Vanguard, and they're pushing, well, not pushing, but suggested something called the Vanguard Ultra Short Treasury ETF, VGUS, and a Vanguard 0 to 3 month Treasury Bill ETF, VBIL. I didn't know if you had any opinions about those, or is the best place just to do like federal money market funds or government money funds? And the money is at both Fidelity and Vanguard. So any suggestions? Right now it's in a mixture of CDs and government money funds and that kind of thing.
Yeah, I mean, the good news is cash is not trash right now. You still can make decent money, high yield savings, as you mentioned, CDs, money market, all that stuff kind of paying around that 4% mark. So then it gets into what fluctuations are possible in those securities that could change that balance in the next year. That's what we don't want to see. We don't want to see something invested and then have it go down and now you're short of the money you need to buy the house.
And here's the thing. The reason they're pushing these two ETFs is because they don't have any money in them. I mean, for example, the Vanguard Ultra Short Treasury has $139 million in the portfolio.
Just a pittance for Vanguard.
And so they just don't have any money in them yet. There is the potential for a little bit of fluctuation in the value of these two ETFs. Whereas in a money market mutual fund or in a short-term savings vehicle of some kind or even a CD, there should be, as long as you don't try to sell the CD early, no fluctuation in value. So if you really want to make sure the money's absolutely there in its entirety, I'd go short-term savings. Thanks for listening.
Tom and Don are talking real money.
This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem So why wait to hire the people your company desperately needs? Use Indeed's sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
For your real life and real future, Tom and Don are talking real money.
Mention a program note here.
It's your money. What? You're not supposed to interrupt until I finish that.
But next weekend, next Saturday show, I will be doing it without Don.
Oh, he's going to be. He's panicking.
I'm pretty much
now.
panicking. That is the reason I brought in someone else who's been on this podcast previously. Roxy Butner will be joining me in studio.
Oh, are you taking the stuff to the office?
Oh, yeah. I'm going to be doing it live from beautiful Bellevue.
You're not making her come to the laundry room?
Nobody has to drive this far out, nor deal with everything in the laundry room. So
Tom and Roxy do laundry on Saturday.
So join me next Saturday. It's going to be a little different than this Saturday.
But for now, join us today at 855-935-TALK, 855-935-8255. And let's head down south to West Palm Beach, Florida. Bob, welcome to the program.
Yes, thank you for taking my call. I have a question about two bonds. For my retirement account, for relatively safe growth, I will not need the money for a foreseeable future. My question is, I can buy a federal housing loan bank bond paying about 6% right now for 10, 20 years. The problem is that those bonds has a call feature, so they might be called early. But what are disadvantages of investing federal housing loan bank paying presently close to 6%?
One, the call feature. That if rates fall dramatically, then they're going to call those higher rate notes away. There is always there's likely to be, although the call does protect somewhat against volatility, there is volatility anytime you buy individual securities if you want to sell them into the secondary market. There are bid-ask spreads that come into play in the secondary market.
By whatever the interest rates.
The value could be affected, but there will be some, if interest rates, that's the problem. You've got downside risk in the callability with our downside interest rate risk, and upside interest rate risk is that the value of those bonds will deteriorate if rates rise like crazy. So that they have. This is why we don't often suggest individual bonds to people, because of the more individualized, even though there's no risk of default. There really is inherently no risk.
But I'm trying to understand why they're paying 6%.
Well, I bought yesterday 5.95% for 20 years.
And that the reason they're paying 5.95 is, one, the call feature takes away some of their attractiveness, because if rates fall, investors are going to lose the bond. You're going to lose your high rate that you were counting on. And that the reason rates part of the reason the rate is high too is because of the 20-year factor, which is risk should rates rise. So we would never suggest any of our clients use these in their portfolios ever.
Okay, I understand. Another quick question. The other question that I have is PIMCO Dynamic Income Fund. For last year, the value doesn't fluctuate much, but it's making about 14%. How can it be? I don't understand. How can they pay 14%?
I need to look
Dynamic
it up.
Income Fund? Who operates that fund, Bob?
Yeah.
It's PIMCO.
PIMCO. 14?
It's PDI. PIMCO Dynamic Income Fund.
I was just looking at
D as Donald, I Irene. PDI.
Okay. Let's look at what it's
the value
made
doesn't
up
fluctuate
of.
much, but they pay 14%. How can it be?
Again, this is not a fund I know. The distribution rate is 14, but that's the distribution rate, which I believe includes
your capital.
Includes the sale of securities. Oh my gosh, is that a junky portfolio? What are these things? Oh, they've got private.
They use leverage, it looks like, too.
Products. They're leveraged like crazy.
But let's go back while Don's doing that,
low.
Bob. Here's the
it's
thing.
a 10 standard
Here's
deviation.
the thing to think about around this fund and around bonds. We hold bonds. We suggest you hold bonds for stability, for ballast in your portfolio. This is not a fund that's going to do that. This is a fund that's going to have fluctuations. This fund could lose a lot of money in difficult times. So you're looking at like...
It hasn't.
But it could.
That's the thing with PIMCO.
Yeah.
PIMCO has at times had extraordinary performance in some of their products. But remember, in 2022, they lost 16%. Lost 16 net. So they can lose.
Tom and Don are talking real money.
Every day, thousands of Comcast engineers and technologists, like Kunle, put people at the heart of everything they create.
In the average household, there are dozens of connected devices. Here in the Comcast family, we're building an integrated in-home Wi-Fi solution for millions of families like my own. It brings people together in meaningful ways.
Kunle and his team are building a Wi-Fi experience that connects 1 billion devices every year. Learn more about how Comcast is redefining the future of connectivity at comcastcorporation.com/Wi-Fi.
Your guides to a really great financial future. Tom and Don are talking real money.
The drama of the day is finally settled. I'm so happy. I'm really happy. There's no joke, actually. The Shadir Sanders watch is over. We can move on to the Pope watch now. So he got picked up by the Browns. So I've been worried about that for 2 days. So that's
laundry
good.
talk and football talk. I don't care about Shadir Sanders.
And now we can move on to the Pope watch.
And by the way,
So
that market maker in the lovely land of exchange traded funds is known as an AP or an authorized participant. And because they're an authorized participant, they are always looking at what the difference is between the net asset value of the fund and the actual market value, and they're allowed to just turn in those ETFs and take the stock, or then sell it and make money. So
they can arbitrage that situation to some extent. Sure.
Anyway, talking to BC about rebalancing, and you balance every year, but you're wondering about rebalancing at a price
things
point,
get out
right?
of sync during. Yeah.
I can see it if the
percentage point. Say something.
To me, 5 is it's going to mean I'm going to be trading too much in markets like this, because you could have 5% one day and then 5% the next day and then 5% the next day and then 5% the day after that. And the other thing that enters into the equation is, where is that money held? Is it in a taxable account or tax-free account?
No, he said
401.
It's 401k.
Okay, in a 401,
he rebalances his 401k.
Then it doesn't really
if something
matter
gets out of sync,
how
what
often
do
do it. My worry would be doing it in another account. And bear in mind, all accounts should kind of be rebalanced together.
Yeah, and the other worry I would have, BC, frankly, is if you did the rebalance of 5th of January, whatever, you went back to your 60, 40, 80, 20, whatever it is, and then the market does something, now you're going to rebalance again. What's likely to happen is you're going to get whiplashed. It's just things are going to move up and down. I would just stay with the once a year, a date, your birthday, whatever it is, do the rebalance. I'll see you next year. Remember, you're putting the money in at the correct percentages anyway, right?
As you're adding, good
this
point.
much small, this much, as you're adding money in. So you're going to fill in those blanks to some extent anyway. I wouldn't do it more than once a year under that circumstance.
Does that help?
Okay, that's what I was thinking. I do 20% across 5 different Vanguard mutual funds, so I'm confident in that.
Plus, the other thing is it's a pain.
Yeah, it's a lot of work.
I got better things to do. I don't really, as a matter of fact, I only look at my portfolio. I probably look at it 3 to 4 times a year. And I don't want to look at it more often because it freaks me out sometimes. So I don't look. Don't peek, as Jack Bogle said. Don't peek. 855-935-TALK is our phone number here at Talking Real Money. And now we're heading to Albuquerque, New Mexico. Albuquerque. Casey, welcome to the program.
Don and Tom, what's up, fellas?
Hey, good to hear
Saturday
from you. What can we do for you today?
You too.
Okay. So I'm a federal employee, and I am 48. I'm one of those guys who just decided that he just wants to be retire as soon as possible, or at least be ready as soon as possible. So I think they told me 57 would be my earliest retirement age where I could start drawing my pension with the Postal Service. And I know the TSP, I'm doing all traditional. I think 59 and a half is when I can start taking money out not tax free, but without penalty. So my question is, I'm up to 20% of my paycheck now into my TSP. I always hear you guys talk about the stock market historically has been, since its inception, I think 10% return lifetime since the early 1900s. Would it make sense for me to just put all my money in my C fund? And would that be diverse enough given the history of the stock market? That way I don't have to keep going into my portfolio every 6 months or however and making changes and whatnot, and I can just ride the market and
wait a minute. He goes back to what we were just talking about.
Fund?
Yeah.
Yeah, I mean, you'll be breaking bad if you do that. I mean,
bad.
No way.
Albuquerque joke. You need S and I at least.
Yeah, I do a third in each one.
Okay,
you make it simple if you're going to be all stocks.
I don't mind you being all stocks.
Okay, so
yeah. And I wouldn't count on 10% either. No offense. I mean, very few people make 10%.
Although historically, pre-inflation.
If I was running the numbers, I'd run it at about 8.
Well, you always go more conservative, but okay. I don't think that in an all equity portfolio where you have small, you have large, you have international, you have U.S. I don't think it's unreasonable based on 100 years to say you could pull off 10, but I wouldn't expect it. Don't expect something that high,
especially a short period of time. By the way, yeah.
Gotcha. Okay. And let me squeeze one more in. I'm really trying to simplify my retirement and investments. Now, I hear a lot about the Roth, and I keep thinking to myself, would it make more sense for me to just keep putting more into my TSP rather than just taking money from that and putting it into a Roth IRA? What would you say about that?
What's your current tax rate?
Oh, I think I'm pretty low. I'm married with 2 school-age kids.
So he's the king.
I usually get money back at the end of every year.
The king of exemptions. So he's doing really well with those exemptions. Just keep making exemptions. Keep making more exemptions.
Well, I mean,
yeah,
it's worked for me.
Whenever Tom's tax rate gets a little high, he just makes an exemption.
That's a separate phone call, but yes.
Exactly. Here's another one.
Not like Elon Musk, though. He makes so much money. Yeah. He makes so much money. He has to make 4 or 5 at the same time.
God, please. Yes, so but you have basically another 10 years of saving, right? And what the question would be, should you do it pre-tax or post-tax? Mm-hmm. That'd be kind of the question.
Well,
and frankly,
I don't want to. I'd rather put that in. I'm sorry to cut you off, but I just want to know if I should just put that in. Okay, into the TSP instead of just having a TSP and a Roth IRA account on the side.
Well, if you could do both, I'd do both. But if it's a one or another circumstance, It depends a bit on what your tax rate is today and what it's going to be in 10 years, which we can't tell you. We don't know that. Yeah. That's the problem. So that's why sometimes we say split the baby, do a little here, do a little there. Then you're kind of, hedging your bets,
unless you're Elon Musk, the odds are pretty good you'll be in a lower bracket in retirement. So unless you really think you're going to put millions away in savings, and I mean millions, not 1 million, because 1 million isn't going to put you in much of a bracket at all, along with a pension or Social Security. But many millions could. If you're going to save to where you have multiple millions, then you might want to do both, or you might want to lean Roth. But otherwise, take the break now, because we don't know what the future is going to bring.
True.
Yep.
You do know the rate today.
Gotcha.
Bird in the hand.
Gotcha. Thank you.
By the way, we got to ask, did the pizza ever come off the house, or is that still up there?
The pizza is off the house. I keep meaning
to go by Albuquerque. Okay, just checking. Just want to make sure.
What are you going to do in retirement, by the way, Casey?
I want to travel. I want to see the world. I want to, I want to get a head start on seeing the world now, and I figure by the time I retire, you know, I want to have enough money to travel at least probably once a quarter.
That's a good goal. Thank you so much, because some people don't have a goal. They're going, I just want to retire because I don't want to work anymore. 855-935-TALK. Call us.
Tom and Don are talking real money.
At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can even finish the bachelor's degree you started in 22 months for $20,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by pace, transfer credits, and other factors. Fees apply.
For your real life and real future, Tom and Don are talking real money.
Okay. You know, let's talk about money. One of the things that makes a company valuable, one of its many assets. Yeah.
Assets?
An asset that makes it valuable. It's called its IP, its intellectual product, its goodwill, it's the name. For example, if you owned the name, and I don't own it, McDonald's, as a matter of fact, I know I don't own it because McDonald's has sued me over using my own name, basically, or threatened to. If you have a great name brand, you know, like Apple, I want to start a line of clothing called Apple. You know, you're gonna get some cachet just because of how well known it is. So you're gonna get sued if you use that. So sometimes brands are worth a lot of money. Now there's a brand. On the other hand, you guys remember the name the name Billy McFarland? Does that ring a bell with you? Did you watch any of the documentaries on the Fyre Festival?
There were two of them, by the way, not one.
What did you get
two.
when you went to the Fyre Festival? You got like a blow-up mattress and a cheese sandwich, right?
Cheese sandwich and a FEMA tent.
You got an experience that it would be hard to call it valuable. I mean, it's not like people are going,
well, so it was so good that the founder ended up spending 4 years in prison or something.
He did. And now he's back. He's out of prison, and he wanted to do it again. But he decided that, no, it's time to pass the torch. He's selling the name Fyre Fest, the
brand.
The sputtering torch. He wants to pass that wet, sputtering torch.
You can put this on the list of things never to invest in. Right there. You can just put a line. I have no idea. This absolutely, I mean, it's good for him for getting all this publicity, but this is insanity that he thinks he can sell the brand. It's not even the festival itself. It's the brand.
Fyre.
It's the
just
wonderful
Fyre
name
and
you
their
get.
website. They get the website.
Yeah. Fyre Festival.
Yeah, no, it says you get the digital assets.
Let's see.
And you get, by the way, the cultural capital, which has done wonders for American processed cheese foods.
Good point. So, by the way, the Fyre Festival 2, for those of you who are smart enough to sign up for that, it's $1,400. High rollers can pay $5,000 for the VIP. But if you want to be the Prometheus God of Fire package, which includes the yacht, private chauffeur, that's $1.1 million.
He has now confirmed that it will not take place.
Oh, God's sake.
So you can't, no.
Really?
And by the way, if you want a refund, you need to ask. They're not going to give it to you if you don't ask. You have to actually ask. Now, what do you think will be their response when you ask?
Billy.
I
Crickets?
think, little bit of that.
Love it. Thank you, Billy, for entertaining us this way. It really is very
hold on. Wait a minute.
Hold
on. I'm checking.
How much you going to throw into the pot there?
Checking what I got.
Checking your wallet? Because I don't bring mine to the show, as
60,
you know. So.
You know, just for the just for the fun of it, I'll give Billy $63. I got.
Don't say that. He might be listening. Call you right now,
Billy. I will give you $63 for it. There you go. Right now, buying the trademark. All right,
30.
So,
all right. If you want some help, by the way, a couple things coming up.
If you need $63, let me know.
May 21st. Just like I just did in Arizona, meeting with people. Love it. May 21st. Let us know. Go to talkingrealmoney.com. Click on Meet an Advisor. If you somewhere else want help, do the same. Yeah, we don't have to be in Portland for that one. So we're here to help you get it all right.
$63 right here. $63.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?